So welcome back after this break. Question number 56 in front of you. This is the following question, and this question is regarding the financial reconstruction. Financial reconstruction. If you might have learned about this concept of reconstruction account, preparing a reconstruction account in accounts subject in, I think, CA Foundation or CA Inter. It is related to the same thing. What happens is that mostly when the company is not doing good, we normally tend to reconstruct the company. We will ask the creditors to waive off some of their amounts due, and the creditors will always do that because like receiving lesser amount is always better than receiving no amount. So have a look on this question. The following is the balance sheet of XYZ Limited, and you can see there are 6 lakhs equity shares of rupees 100 each, 600. 2 lakhs 14% preference shares of rupees 100 each. Okay, 2 into 100, 200 lakhs. 13% debentures, 200 lakhs. Debenture interest accrued and payable. This is one of the worst thing that will represent in the balance sheet. This should never represent in the this should never appear in the balance sheet, because it means that 26 lakhs of the interest that we have defaulted on. Loan from bank 74 lakhs, trade creditors 300 lakhs. Okay, on the asset side you can see we have land and building, plant and machinery, furniture and fixtures. All these three items relate to the fixed assets. Then inventory, sundry debtor, cash at banks, these are related to current assets. And again, something which should not appear in the balance sheet, which gives a bad impression of the balance sheet, is the preliminary expenses, cost of issue of debentures, and profit and loss account in debit balance 485. That means this is purely a loss, because if it would have been a profit, it would have presented in the or appeared in the credit side. Okay. The company did not perform well and has suffered sizable losses during the last few years. However, it is felt that the company could be nursed back to health by proper financial restructuring. So what we are going to do? We are going to do the financial restructuring of this company. Consequently, the following scheme of reconstruction has been devised. So now there is a scheme of reconstruction. What will happen? Equity shares are to be reduced to 25 rupees per share fully paid up. Right now it is 100 rupees. Can you just imagine? 75% of the equity share will get waived off, like written off. What will be the entry of that? Equity share account debit. The equity share of account debit by 450 lakhs. 75 into 6. Yes, 450 lakhs. Because you want to bring down the paid up value from 100 to 25, that means you are writing off 75 rupees. And the balance will be transferred to reconstruction account. See, this share capital account will get debit. I will just write down. Share capital debit 450 to reconstruction account 450. Okay. Then preference shares are to be reduced with a dividend rate of 10% to equal number of shares of rupees 50 each. Right now they are 100 each. 2 lakh shares with 10% preference shares. So now you are reducing the future earnings on the preference shares from 14% to 10%, and also you are writing off 50% of the preference shares value from 100 to 50. That means you are writing off 100 lakhs of preference shares. So again, preference shares account debit to reconstruction account 100 lakhs. Now just imagine what will happen. After the entry is made, this will look like 150 lakhs. This will become 100 lakhs. Out of 200, it will only be 100 lakhs in the after reconstruction balance sheet. Equity shares will be only 150 lakhs. Okay. Preference share will be only 100 lakhs. It will be of 10%, 50 each. This will be of 25 each. Now, what else is given? Debenture holders have agreed to forego the accrued interest due to them. Beside this, they have agreed to accept the new debentures carrying a coupon rate of 9%. See, couple of more things. This 13% debentures will now be only 9%. and this debenture interest, they are ready to forego this amount, so it will get zeroed. What will happen? The reconstruction account will get credited with 26 lakhs. It got credited. This is the reconstruction account. It got credited with 450 here, 100 here, and 26 here. We need to be very careful about the amount, because we have to match the balance sheet at the end. Okay. What are we going to do now? Trade creditors agree to forego 25% of their existing claim. For the balance sum, they have agreed to convert their claims into equity shares of rupees 25 each. Now understand what is happening. First of all, trade creditors of 300 lakhs. They are ready to forego 75 lakh rupees. So trade creditors debit to reconstruction account 75 lakh. Now what is left is 225. Okay. What is left is 225, and now we are going to debit the entire trade creditors with 225 lakhs, and we are going to issue them equity shares worth 25. So how many equity shares? 9 lakh equity shares will be issued to them. So what will happen after this? The total equity share will become 15 lakh. Do you agree with this? 6 lakhs plus 9, and 225 will be added to the equity shareholders. That is 150 plus 225. That will be 375 now. It will get removed totally from here. This trade creditors of 300 got distributed into two parts. One transferred to the reconstruction account 75, and the other one transferred to the equity shares, and the equity shares has increased from 150 to 375. The total number of shares has also increased from 6 lakhs to 15 lakh. Okay, sir. So I think we are done with the liability side totally. Now let's come to the asset side. In order to make the payment for bank loan and augment the working capital, the company issues 6 lakhs equity shares of rupees 25 each. The entire sum is required to be paid on application. What is the entry for this? Cash account debit 150 lakhs to share capital 150 lakhs. What exactly we are doing? We are raising new capital, so that will add 150 lakhs on both the side. Now what is happening? We are again raising 6 lakhs equity shares, so the total number of equity share will go to 21 lakhs, and we are raising 150 lakhs. I will just write it like this. It was 150 earlier, then we added 225 to make it 375, then we are adding 150 lakhs more, 6 into 25 as a capital. So that will be, now the share capital will look like 525. 21 lakh equity shares of 25 rupees each. This entry of 150 lakh rupees of the cash issued will add the cash and bank balance, will add to the cash and bank balance, and the cash and bank balance will be now 280 lakhs. Right? We have issued new equity shares. It will add the cash, it will increase the cash balance and the equity balance on both the sides. So this will get tallied. Okay, what else? Now look at this part, sixth one. While the land and building is to be revalued at 250 lakhs, plant and machinery was to be written down by 1054 lakh. Now there is a mistake in the question. Either the question is wrong or the answer is wrong. What they have done is, the treatment in the answer is it should be written down at 104 lakhs. So if you write by, it has a different meaning. If you write at, it has a different meaning. So we can change the answer, we can change the question. Whatever we do, we have to go accordingly. Right now, I am changing the question itself, written down at 104 lakhs. That means I am reducing the what we can say, the balance in the plant and machinery account to 104 lakhs. Okay. And the provision amounting to 5 lakh is to be made for bad and doubtful debts. So try to understand now what is happening. We are making this land and building to 250 lakhs. That means 50 lakhs will be increased in the land and building. So it will be debited in the land and building and credited in the reconstruction account. So this is the reconstruction account that we have been preparing. All these are the credit balance. We are going to add this credit balance also. Okay, then second, plant and machinery is to be taken down to 104 lakh. That means what is happening? We are reducing around 196 lakhs out of plant and machinery. So we are reducing. That means plant and machinery credit by 196 and the debit will go to reconstruction account. Okay. One more thing, there is a provision for bad and doubtful debt of 5 lakh rupees. Okay. That provision for bad and doubtful debt, how are you going to enter that amount? 70 minus 5. You will just credit the sundry debtors and it will become 65. The debit balance of that will go to the reconstruction account. Apart from that, all these losses or preliminary expenses will be written off. If you have understood the concept of reconstruction, all the bad things are automatically transferred to the reconstruction account even if it is not written in the question. So all these three items, preliminary expenses, cost of issue of debentures and the profit and loss account, will get credited in their account and debited to the reconstruction account. So 10, 5 and 4, 10, 5 and 485. Now let's do the total of the reconstruction account. The balance, the extra account that we have created in order to restructure the balance sheet. 450 plus 100 plus 26 plus 75 plus 50. So it comes to the balance of 701 lakh. What is 701 lakh, sir? This is the credit that we have. This is the credit amount in the reconstruction account. Extra balance that we have transferred from the balance sheet to the reconstruction account. We have a credit balance of that. And this 701 crore is now used for writing of all these expenses. These are the debit balance of the reconstruction account. So minus 196 minus 5 minus 10 minus 5 minus 485. The reconstruction account balance is 0 now. You will prepare the reconstruction like this in T format. The total of the credit balance should be 701 and the total of debit balance is also coming to 701. In this question, coincidentally, this is coming to 701. Otherwise, what would have happened? The rest of the credit balance, let's say for example, the credit balance is 701 and the debit balance is only 501. So what will happen? The balance amount will be transferred to capital reserve 200 and it will be taken over to the balance sheet in the credit side. So please understand, in the next question, if the question is asked in the exam, if there is a still balance in the reconstruction account, which mostly is, I don't know why in this question the question has been framed in such a way that the balance is not there. But most of the time there will be a leftover balance in the reconstruction account. If there is a credit balance, you will write it on the debit side and it will be transferred to capital reserve. If there is a debit balance, you will write it on the credit side and it will be transferred to goodwill. That's it. So for now, I am just not transferring anything to capital reserve or goodwill because we are like the debit side and the credit side is matching. So you will not see any new account in the balance sheet now, but the balance sheet will be revised with all these figures. Let's compare the balance sheet now. See, do you realize 121 lakh shares of 25 each worth 525? Okay. The preference shares has reduced from 14% to 10% of 50 each to 100 lakhs. The debentures has also been reduced in the interest and the amount is 200 same. There is no trade creditors here. You can see there is no creditors in this case. Okay, sir. Then we will see the bank loan is also not there. What happened to the bank loan? We paid off the bank loan. So the balance of the cash account will get reduced by that much of the amount. So the loan from the bank was 74. You will just debit this loan and reduce the amount from the cash bank balance. So the cash and bank balance will be 206 lakhs only. Okay. Coming over to the asset side. Land and building at 250, plant and machinery at 104, furniture fixture same, inventory same. Sundry debtors, you can see it is reduced by 5 lakhs 65, cash and bank balance 206. Cash and bank balance was, see, I will tell you, it was the 130 lakhs opening balance. You added 150 lakhs by issuing new equity shares. So the total became 280 lakhs. And after that, you made a payment to the bank for loan of 74 lakhs. Now the net balance is 206. Ultimately, the balance sheet will match because for every adjustment you were giving two impacts, the debit and credit. So the balance sheet has to match at the end of the day. If it is not matching, that means you have done something wrong. So all the adjustments, most of the adjustments will go to the reconstruction account, the debit and the credit, and the entire balance of the reconstruction account will either be transferred to the capital reserve or goodwill. Mostly it will be transferred to the capital reserve. So if you will see similar type of questions somewhere else, you will see that after the equity share there is one more head which is called as capital reserve. So the balance of the reconstruction account is mostly transferred to that capital reserve account. This is called as financial restructuring, or we can say restructuring. So our chapter's name is mergers, acquisition and corporate restructuring, right? This corporate restructuring example was this, where we reduce some liabilities, bring back the land, fixed assets on realizable value or the current values, and whatever the transfer is, we will transfer all the losses. Whatever the transfer is, we are going to do it in the reconstruction account, and that reconstruction account's balance will be transferred as a capital reserve account in this case. Next question, easy one. This one is easy. The Nishan Limited is 35,000. Just take this entire question, previous question, remove it from your mind and focus on the new one now. The Nishan Limited has 35,000 equity shares of equity stock outstanding with a book value of rupees 20. So 35,000 into 20 is 7 lakh. It owes debt of 15 lakh at an interest rate of 12%. Selected financial results are as follows: EBIT, interest, EBT is negative, no tax, EAT, depreciation, principal repayment, cash flow. Okay, negative cash flow, you can see. Evaluate and restructure the financial line items shown, assuming a composition in which creditors, that means the debt in the company, agree to convert 2/3 of their debt into equity at a book value. They have 15 lakhs in debt. 2/3 of it is 10 lakhs. So right now we have equity of 7, debt of 15. Out of this, 10 lakh will be transferred to equity. So after that it will look like 17 and 5. But this will also impact the interest in the profit statement or cash flow statement. Assume Nishan Limited will pay tax at a rate of 15% on the income after restructuring, and that principal repayments are reduced proportionately, 2/3. The principal repayment will also get reduced. Demonstrate as to who will control the company and by how big a margin after the restructuring. Obviously, who will control the company? The company will be controlled by the debt holders, because they will be holding 10 lakh worth of shares equity, while the previous owners were holding only 7 lakh equity shareholders. So the majority of the company will be controlled by creditors. Acha, one more thing that will happen. So basically this 15 lakh, out of this 15 lakh, 10 lakh worth of shares, 10 lakh divided by 20, we are going to issue them 50,000 shares. We are holding only 35, but we are issuing 50,000 shares to them. So obviously the control will go to the creditors because they are holding more than we are holding that. Okay, so 2/3 of the debt has been reduced. What will happen? 12% interest on 5 lakh. Now what is the balance in the debt? 5 lakh. The new debt will be 5 lakh and equity will be 17 lakh. So what will be the new interest? 12% on 5 lakh. It will look like 80,000 minus 60,000. 5 lakh into 12%, 60,000. The EBT will be 20,000. The tax rate is 15%, so 3,000 will be the tax. Balance earning after tax will be 17,000. Depreciation add back 50,000, and the principal repayment will also get reduced by 2/3. So only 1/3 will continue. That means principal repayment of 25,000, and the balance will be 17,000 plus 50,000 minus 25,000. That's 42,000. It is going to look like this. So after reconstruction, the income and cash flow will look like this. The interest amount will also reduced by 2/3. It will come down to 60,000. There will be some profit on which we will be paying some taxes, earning after taxes, depreciation, and then this. Let's have a look. Easy question. See, 80, 60, 20, 3, 17. And this is the new structure. That's it. After the restructuring, there will be a total of 35,000 plus 50,000, 85,000 shares of equity. Original shareholders will still own 35,000, while the creditors will own 50,000 shares. Hence, the creditor will control the majority or substantial company. Quite easy. Okay. See what we have reached till now. We are about to finish the chapter, and that's why I'm going to again come back to this point. We have seen some questions on the corporate restructuring. Before that, it was divestiture decision, maximum and minimum exchange ratio, non-performing asset, capital adequacy ratio. These were the most difficult part of the entire syllabus. Now we are going to slowly shift from the difficult to the easiest question for the rest of the part, and we are going to finish the question. In the next few questions will be on the geared and ungeared beta and capital structure decision. We are going to use the Gordon's growth model as well, and external fund requirement. So let's have a look on the last phase of the mergers and acquisition chapter. So this is the question in front of you. Let's read it. Question number 58. So this is the question on geared and ungeared beta as well. XYZ, a large business house, is planning to acquire ABC, another business entity in similar line of business. XYZ has expressed its interest in making a bid for ABC. This is target, this is acquirer. Now XYZ expects that after acquisition, the annual earning of ABC, that means the company that we are going to buy, will increase by 10%. What will increase? The annual earning increase by 10%. Following information, ignoring any potential synergistic benefit, whatever the benefit will be there, that is 10%. This 10% increases the potential synergy benefit, right? Arising out of the possible acquisitions are, without considering the synergy benefit, the details are given to you. Please focus. Paid up capital in crore of XYZ and ABC. Who is XYZ? XYZ is the acquirer. Now try to understand. This is acquirer, this is target. Now, proxy entity for XYZ and ABC in the same line of business. This is the third company in the same line of business. Paid up capital is given. Okay. Face value of rupees 10 per share. Current share price is given. Debt equity ratio is given, and the equity beta is given. Okay, sir. Assume the beta of the debt to be 0. Corporate tax rate is 30%. Determine the beta of combined entity. Determine the beta of combined entity. How will you calculate the beta of combined entity? See, you have the paid up capital and the face value and the current share prices as well right now. What you can do is you can calculate the number of share with this. Then you, with the current share price, you can calculate the market value. Then you can total that market value as well. Just a second. Yeah, in this part only 10% of the earnings is given. So how will you calculate the combined beta? Combined beta means portfolio beta, right? Beta of the portfolio. And how do we calculate the beta of the portfolio? Let's go step by step. This is question number 58. Portfolio beta is equal to summation of weight I beta I. That means weight of ABC, beta of ABC plus weight of XYZ into beta of XYZ. First of all, let's focus simply on the weight of both the companies. How to calculate the weight, I will show you. You have the paid up capital divided by the face value. You will get the number of share, multiply it with the current share price. You will get the market value of each company. Let's try doing it. So the number of share will be 102.5 and 10.6. Okay, and once we multiply it, the market value is 13,284, 583, and the total market value is, let me just check the market value, 13,867. 13,867 is the total market value, right? Now we can calculate the weight of, can we calculate the weight of each? Yes sir, 13,284 divided by 13,867, the weight will be 0.9580 minus 1, that's 0.0420. So these are the weights right now. Now understand, we will put the weights here, 0.9580 into beta plus 0.0420 into beta. So we have calculated the weight based on the market values. Clear with that? Now we want beta of both the companies, but the problem is beta of both the companies XYZ and ABC is not given. It is right here, equity beta. See, you will find no data for those beta is given. But there is one thing which is given in this question is 1.1. Can we take this equity beta in place of this? No sir. Why? Because the debt equity ratio of proxy entity does not matches with the XYZ and ABC. So what we have to do right now, see, we have to take the proxy beta, remove the debt equity of proxy from that, convert that beta to ungeared, and then this ungeared beta will be used for ABC and XYZ. So we will add the debt equity ratio of ABC, we will add the debt equity ratio of XYZ, and then we will have two different betas of ABC and XYZ. So this is what we are going to do, and this is what we have been doing since last two chapters as well in the international financial management, in the corporate valuation. We will take the equity beta of proxy, we will remove the debt equity ratio of proxy out of that, convert that equity beta into levered beta into unlevered beta or ungeared beta, and then after this ungeared beta, again we are going to convert that to geared beta by adding the debt equity of ABC and debt equity of XYZ. So the very first step, geared, this is for proxy, geared beta is equal to ungeared beta 1 plus debt equity ratio one minus tax, right? So what is the geared beta? 1.1. What is the tax rate? 30%. See, so we will find out the ungeared beta out of it. What is the debt equity ratio of the geared company? It's 1:4. We are going to remove this 1:4 impact from 1.1. So let's try 1 by 4 into 0.70 plus 1, 1.175. So the answer is ungeared beta is equal to 0.9362. This is the ungeared beta. So what we have done till now, we have converted 1.1 to 0.9362. Now this 0.9362 will be used two times. One with ABC, with the debt equity of ABC, and then we will calculate the beta of ABC. Have a look. And the other one with the XYZ. Now ABC geared beta is equal to ungeared beta 1 plus debt equity 1 minus tax. So what is the debt equity of ABC? It's 1:2. So I will just write down this for ABC, 0.9362, 1 by 1:2 and 1 minus 0.30. This comes to 1.2639. This is what we are going to use. Then for XYZ, similar thing. Geared beta is equal to 0.9362, 1 plus. What is the debt equity ratio in this XYZ and ABC? So I am writing it wrong. It should be XYZ and ABC. So 0.9362, this is 1:3. 1:3 is the debt equity ratio in ABC. 1 by 3 into 0.70 plus 1 into 0.9362. That comes to 1.1546. See. So that's 1.2639 and 1.1546. 9362, 1.2639. 1.2639 rounded off to 3 decimal, it will be 1.264, 1.264, 1.155, 1.155 rounded off. Now these two figures will be used in the main formula 1.2639. Let's have a look. 1.264 in this main formula of portfolio beta and 1.155. This will be 1.155. Let's do the multiplication. 1.211 plus 0.049. 1.26 is my answer. This is the portfolio beta of combined entity. Let's have a look. See, 1.26 is the answer. Institute has extended this by multiplying directly with the beta, or else you can use the simple formula of weight into beta as well. It will give you the same answer, 1.26. So don't worry about what the institute has done. Whenever you don't understand the procedure by institute now, you just do it by your original method. This is what you learned in the portfolio chapter. The portfolio beta is calculated like weight into beta, weight into beta. Calculate the weights, calculate the beta. The only thing that we had to do in this question is we had to take the proxy beta and remove the debt impact out of it. Use the ungeared beta twice for XYZ and ABC. We needed the geared beta for XYZ and ABC in the formula because we had the debt in the company. That's why we needed geared beta. So what we did ultimately is this: we converted this geared beta into ungeared beta and we used it twice for two different companies to calculate the two geared beta once again. That's it. So we removed the proxy's debt equity and we added the ABC and XYZ's debt equity in this. That's it. Simple question. Okay, sir. Let's move on to the next question now. That is question number 59. ABC, a large business house, is planning to sell its wholly owned subsidiary. Wholly owned, 100%. ABC wants to sell the subsidiary named as KLM. Another large business entity, XYZ, has expressed its interest in making a bid for KLM. So this is going to be acquirer, this is the seller. And this ABC is not selling its entire company, it's just selling one of the division, that is one of the subsidiary KLM. Okay, XYZ is the buyer in this case. its interest in making a bid for KLM. Now, XYZ expects that after acquisition, the annual earning of KLM will increase by 10%, as it was given in the previous question also, that after I acquire this company, the earnings of that subsidiary will grow by 10%. Following information ignoring any potential synergistic benefits arising out of the possible acquisition, that means this increase in 10%. Ignoring this increase of 10%, the data is given. The profit after tax of KLM for the financial year which has just ended is estimated to be 10 crore rupees. KLM's after-tax profit has an increasing trend of 7% each year, and the same is expected to continue. This will be your growth rate. Market rate of return is 10%, risk-free rate of return is 4%. That's it. 4 items are given in these 3 details. First of all, the profit after tax 10 crore, growth rate 7%, market return 10%, risk-free return 4%, and the tax rate 30%. That's it, nothing else. Now, this is the table. Analyze the table for a moment. This is XYZ who wants to buy KLM, acquirer. This is seller who wants to sell its wholly owned subsidiary. Proxy entity for KLM in the same line of business. Now, try to understand once. KLM has a category or is doing such a business which is not similar to XYZ or ABC. Right? It is similar to this proxy entity, and the data of KLM is not given. The data of proxy entity is given. Cool, sir. Let's say we write down the KLM. Why this question will be difficult, a little difficult to you? Because we need the data to calculate the value of KLM, but the KLM's direct data is not given. Okay, instead a similar company is data is given. This company, the proxy entity, the dividend payout ratio of the proxy is 50%, debt to equity is 1:4, PE ratio is 12, and the equity beta is 1.1. Now, assume gearing level of KLM. Gearing means the debt equity ratio of KLM to be same as of ABC. What is the gearing level of ABC? 1:3. So it will be same as of KLM. Let me write down 1:3. Okay, sir. And the debt beta of 0. Now try to understand once again. We can use the data of proxy company, but the only difference in the proxy and KLM, both of them are in the same line of business. So maximum data will match and we can use the data of proxy for KLM. But the only difference is the debt equity ratio. The debt equity ratio of proxy entity is 1:4, whereas the KLM is 1:3. So at the time of using this equity beta, this is called as geared beta. Tell me, can we use this geared beta of 1.1? No, sir. We cannot use, because 1.1 consists of the debt equity risk of 1:4. That is of proxy. But we need an equity beta which includes the risk of 1:3. So what are we going to do? We are going to convert this geared beta into ungeared beta. That means we are going to remove 1:4 ratio out of it, and then we are going to add 1:3 ratio and convert it back to geared beta, which can be used for KLM. Okay, sir. This geared beta will be used in the capital asset pricing model with the market return of 10% and the risk-free return of 4% to calculate the cost of equity. Now, have a look on the question. Calculate the appropriate cost of equity for KLM based on the data available for proxy entity. So, KLM's cost of equity can be calculated using CAPM. Risk-free rate. The question is very easy. Understand. Geared beta, market return minus risk-free return. So in this formula, we have everything except for the geared beta. Now, first question that you can ask is, why do we need geared beta for calculating cost of equity of KLM? Geared beta is required always if we have the debt in the company. If we have zero debt in the company, then we will use the ungeared beta or asset beta. Okay. So it's very much clear that we need geared beta. But this 1.1 of the geared beta cannot be used because this 1.1 of the geared beta includes 1:4 debt ratio. So let's convert the geared beta to ungeared and then ungeared to geared back. Okay. So Simple procedure I'm going to write down once again. It is given here, but just follow the process. What is the formula for geared beta? Always, I'm telling you, this is a suggestion, always start with a formula. Like whenever you are using the formula, don't just like remind yourself of the formula in your mind and then just write down the values directly. Like here, they have started directly with the answer. Never do that. Ungeared beta 1 plus debt equity 1 minus tax. So geared beta is 1.1. Ungeared beta we have to calculate. We have to remove 1:4 debt equity ratio 1.30. So ungeared beta will be, let me calculate, 1.175 comes to 0.9362. So we have converted it from 1.1 to 0.9362. Now use it back to calculate the geared beta of KLM. Geared beta is equal to ungeared beta in bracket 1 plus debt equity 1 minus tax. Ungeared beta is 0.9362 in bracket 1 plus. What is the debt equity ratio of KLM? 1:3. Now can you see the difference here? I will just complete the answer and then we'll get back to you. It comes to 1.1546. See. We removed this part of 1:4 and added 1:3 in the beta. That's it. We wanted to remove someone else's debt equity risk and then add our debt equity risk. That's it. That's it. So the new beta that we can use is 1.1546. Now you can simply use the CAPM model, 10% and 4%, right? So 4% is the risk-free rate, 1.1546 is the beta, and market return is 10 minus 4. So the answer will be 10.93%. This is the cost of equity, 10.93%. That's it. The first answer is resolved. Now, a range of values for KLM, both before and after any potential synergistic benefit to XYZ of the acquisition. Now, what the question is asking us to calculate is the value of KLM, first of all, and then the range. That means there will be two different bases that we have to use. Okay, so two values of KLM before synergy and two value after synergy. After synergy is very easy. You have to just add 10% to the annual earning. That's it. So let's first focus on the before synergy benefits. So we have to calculate values on the basis of two different basis. Like let's find out the basis. What type of basis we can use to calculate? We can use the PE ratio model also to calculate the value. PE ratio multiplied by profit after taxes will give you the market value of KLM. Again, we can use the dividend growth model because we have the cost of equity, we have the growth rate here 7%, and we have the dividend payout ratio as well. So we can use that. So the two bases that can be used, one of the basis is current share price, but try to understand the share price of KLM is not given. The share price of KLM is not given. It's of XYZ and ABC. We don't want to calculate the value of XYZ and ABC. We want to calculate the value for KLM. And the KLM's one data which is given is the profit after tax. And profit after tax is used in the dividend also and this model also. PE ratio. There are two models that you can use in this question. So just have a look. Question number 59. Second part, value of KLM on the basis of PE ratio. Let's start with easy part. What is the PE ratio? What is the PE ratio of KLM? Very easy, sir. There will be two different bases that you can use. You can use the data of proxy also. So at that time the P ratio will be 12. But we can also argue on the fact that XYZ is buying that company. XYZ is buying that KLM, so XYZ will use its own PE ratio. So now there will be two different views for two different values. There will be in total 4 answers for pre-synergistic and 4 answers for post-synergistic. I will just show you. We will write down using XYZ using proxy. See, both of them are right. You can write down one only, you can write down both. So market value, this will be pre-synergy. So what is the formula for PE ratio? Market value is equal to PE ratio into profit after tax. What is the PE ratio of XYZ? It's 10. So we can easily say that 10 multiplied by 10, 100 will be the value of KLM. But if we use the proxy's PE, we can say 12 multiplied by 10, 120 will be the value of KLM. But this is before considering any synergy benefit. If you consider post synergy benefit, like if you consider synergy benefit of 10%, this value has to be increased by 10%. It will be 100 into 1.1, that's 110. 120 into 1.1, that's 132. That's it, simple. You can directly increase. You can increase the earnings as well, or you can increase the value directly, because everything will be multiplied at the end of the day. So these 4 are the values. Now understand, using XYZ data, the pre-synergy value is 100 and the post-synergy value is 110. Using proxy data, the pre and post synergy values are 120 and 32. This is just on the basis of PE ratio. Okay, another range that you can use is value of KLM on the basis of Gordon's growth model. Again the same thing, using XYZ's data, using proxy data. Now how to calculate Gordon's growth model? Market value according to Gordon's growth model is equal to earning, see, I will take down profit after taxes multiplied by dividend payout ratio. That means the dividend, right? Numerator should be dividend in bracket 1 plus growth divided by cost of equity minus growth. Am I right? Profit after tax multiplied by dividend payout ratio will give you the amount of dividend, which will then grow by 7% divided by cost of equity minus growth. So what is the dividend payout ratio of XYZ and proxy? You can see the XYZ is paying 40% and proxy is paying 50%. So if we follow the proxy company, we will pay the dividend of 50% of the total profits. But XYZ will argue that we are acquiring KLM and now we will be deciding that how much dividend we are going to pay. So according to our policy, 40% comes the dividend payout ratio. Now, pre-synergy value. Understand, what is profit after tax? 10 crore multiplied by the payout ratio 40% and multiplied by 1.07 will be the growth rate given in the question. 0.1093 is the cost of equity that we have just calculated minus 0.07. So this will be the market value. $108.91. 7% or 6%, let me just check. 7%. Okay, so this will be your pre-synergy market value using XYZ's dividend payout ratio. If we use the proxy's dividend payout ratio, it will be 10 into 50% into 1.07 divided by 0.1093 minus 0.07. that comes to 136.13. Okay, how to calculate the post synergy value? You just have to increase it by 10%. 108.91 into 10%. Okay, sorry, 1.1. 119.801 or 80 and 136.13 into 1.1, that's 149.74. so we have the four values here, 1, 2, 3 and 4, according to the dividend payout ratio. So first of all, see why there are 8 values. 2 into 3, range will have 2 values only. 2 into 3, like 2 cube of 2. First of all, we have pre and post synergy. Then we are using XYZ and proxies data. Then we are using two different methods, PE ratio and Gordon's growth model. Okay, so if you combine all of them, the answer, there will be in total 8 answers. 2 to the power 3, 8. Okay, let's come to the answer and finalize it. 120, 100, 32, 110. See, 120, 100, 132, 110. Then 136, 108, 149, 119. 136, 108, 149 and 119. Now you can just simply take the highest and the lowest value, because range includes the highest and the lowest values. So in a range for pre-synergy, if you look at the pre-synergy, there are only few answers. What is the lowest answer in the pre-synergy? This 100 is the lowest in pre-synergy. 100, 120, 108 and 136. 100 is the lowest. So what is the highest? 136 is the highest in the pre-synergy. Now, what is the lowest and highest in the post-synergy? The lowest is 110 and the highest is 149.74. I think 100 pre-synergy is 136. Yeah. So see these values, 100 and 136, 110 and 149. 100 and 136, 110 and 149. What they have taken is the lowest in pre-synergy and highest in pre-synergy, plus lowest in post-synergy, highest in post-synergy. That's it. All the other values that we have left come in between the lowest and the highest range. So this becomes the range of KLM. See, you can argue on the answer, sir, how will we get to know that we have to use the proxy entities also data and the XYZ's data? Absolutely correct. You can use any one data like XYZ's data and finalize the answer, proxies data and finalize the answer. That's totally correct. But there will be at least 4 answers. Okay, sir, this was question number 59. I hope you understood that. Question number 60 is another and the last question on the geared and ungeared beta. 61 is similar to that. We are going to take it as homework. Now, I think 61, 61 will be given as homework, and 60, 62 and 63 will be taken by us. So let's have a look. Interesting question. Equity of KGF Limited is 410 crore. Debt is 170 crore. So let's start. Equity 410, debt is 170. The total is 580 crore, right? Printer division segment value is attributable to 74%. Printer division segment's value is attributable to 74%, okay, which has an asset beta of 1.45. Balance value is applied on spares and consumable division, which has an asset beta of 1.20. Now, this entire company has 2 divisions. Try to understand. This is printer division, this is spares and consumable division. This constitutes 74% of the total value. and this constitute 26% of the total value. The asset beta, not the geared one, the ungeared beta of both is given, which is 1.45 and 1.20. This is of the company KGF Limited. Okay. Apart from that, the debt beta of the company KGFL, debt beta is 0.24. So debt beta is not given on a division basis. It is for the entire company. Okay. Debt beta is equal to 0.24. Asset beta of entire company is not known to us. Why? Because the asset beta that has been given is in two different parts. What we can do is we can calculate the portfolio asset beta, weighted average asset beta, by calculating weighted average asset beta by multiplying the asset beta of both the division with the values. So 1.45, see, 1.45 into 74% will give you 1.073. 1.20 into 26% will give you 0.003. 1.20 into 26%, 0.312. That's what I said. How is this possible? 0.312. So 1.073 plus 0.312 will give us 1.385. This becomes the asset beta of the entire company. Do you get that? Let me show you. This is KGFL. Beta asset is given in two different format, 1.45 also and 1.20, and the debt beta is given as 0.24. We can calculate the equity beta. So in order to calculate the equity beta, we have to first calculate the asset beta. Asset beta is equal to weighted average of the debt and equity beta. How to calculate? If you remember the geared and ungeared formula, asset beta is equal to weight of equity multiplied by beta of equity plus weight of debt multiplied by beta of debt. What used to happen was, we used to assume this debt beta as 0, and that's why the geared ungeared part was like this much only. But now it is like this. So what is the weight of equity and weight of debt? We can calculate that using this. We have the total 580. 410 by 580 will be the weight of equity. 410 by 580 will be the weight of equity. We have to calculate the equity beta plus 170 of the debt by 580 is the weight of debt, and now the beta of debt is 0.24. Beta of asset has already been calculated by us as the weighted average of the printer division and spares and consumable, that's 1.385. Now try to understand, this is what the total is. This asset beta is the weighted average of both. Okay. 0.70, 170 into 0.24 divided by 580, 1.385 is equal to 0.0703. 0.7069 equity beta. So if we solve this equation, equity beta will be 1.86. The very first question that it is asking is calculate the equity beta. Equity beta can be calculated as 1.86 like this. Beta of the asset is the weighted average of equity and debt. So we need 3. In order to calculate the equity beta, we need beta of the asset. Beta of the debt is already given. Beta of the asset is calculated from the weighted average. So let's have a look on the answer first. So this is the beta of the asset, weighted average 1.385. Then you will keep it here. Look at the formula. Beta of the asset is equal to beta of equity into equity by debt equity, the total of the capital, then beta of the debt into debt by equity plus debt. That's it. So accordingly, beta of the equity comes to 1.86. Cool. Okay. The second part is quite interesting. Ascertain the equity beta if KGF Limited decides to change its debt equity position by raising further debt. We are buying more debt. We already have 170 crore in our debt, in our capital. We are going to now raise further debt and buy back of equity to have its debt equity ratio at 1.90. See, we are going to buy back some equity and raise the debt. So what will happen? The total will remain same, 580. Okay, so I think let's do it like this. Total capital is 580. Debt equity ratio. What is the debt equity ratio required? The debt equity ratio has to be 1.9. So it should be 1.9 is to 1. Okay. How much is the total then? 1.9 plus 1. 2.9 rupees is the total capital, and out of 2.9, the debt ratio will be 1.9 by 2.9. So have a look. Debt ratio will be 1.9 divided by 1.9 plus 1. So this is debt, this is debt, this is equity. This is equity. So out of every 2.90 of the capital, 1.90 should be the debt. So how much the total debt can be? 1.9 divided by 2.9, or we can say, I will keep it here, and total or maximum debt that we can keep is out of 580 will be divided by 2.9. This is the total multiplied by 1.9. So this will be 580 by 2.9 into 1.90, that's 380. Total debt that we can have maximum is 380. Now, first of all, deduct the existing debt. We already have 170 in our capital. Okay, 170. So additional debt to be raised. Additional we can raise this much. 380 minus 170, that's 210. That's it. In total, we will have the debt of 380 in terms of existing 170, additional 210. Now, equity balance after buyback will be, total capital is 580 minus 380 is the debt. So 200 will be the equity capital now. So we have the three different types of capital structure. I will just write it down here. Equity, debt, old, debt, new. 200, 170 and 210. This is the procedure, 580. Now understand what this is the amount. Now let's calculate the weight of each. 200 divided by 580 comes to 0.3448. 170 by 580 is 0.2931. Then 210 divided by 580 is 0.3621. This is the weight of each of the capital in the company. We have to calculate the equity beta. We have to calculate the equity beta. This figure, let's say this figure is X, or we can straight away keep it as beta of equity. So this is the beta of equity. What is the beta of old debt and new debt? Old debt is 0.24, right? And listen to this. Assume that the present beta debt is 0.35. Now they have changed this beta from 0.24 to 0.35. So let's change it. It is now 0.35, and the additional debt that we are going to raise will have a beta of 0.40. So it will be 0.40. That's it. So can we calculate the asset beta is equal to equity beta into weight of equity plus beta of the debt old multiplied by weight of the debt old plus beta of the debt new multiplied by weight of the debt new. It's the same thing. It's the same formula, sir. The concept will not change. This is new. So write down. Asset beta is 1.3875, right? Let's find out from the previous answer. 1.385. Asset beta is 1.385. We have to calculate the equity beta. The weight of equity is 0.3448 plus what is the debt beta? Old beta is 0.35. Old weight is 0.2931 plus new debt beta is 0.40. New debt weight is 0.3621. Let's find out the answer. 1.385, 0.3448 equity beta plus 0.1026, 0.1448. So equity beta will be, all the two figures will go on the other side and will get deducted from 1.385 minus 0.1026 minus 0.1448 divided by 0.3448. So the answer comes to 3.299. Let me just check once again. 1.385 minus 0.1026 minus 0.1448 divided by 0.3448. 3.299. That is 3.3. Equity beta has increased. Earlier it was, try to understand, 1.86. Now it has increased to 3.299 or 3.3. Why the beta has increased? Because the debt has increased in the company. Higher the debt amount in the company, higher will be the risk. Higher will be the risk. The more you add the debt, 3.296, it is 299 or 296. If you take it in 4 digits, it will be 3.299. Okay, so higher the amount of debt in the company, higher will be the beta value of equity. That means higher will be the risk on the equity. The third question says that whether the new equity beta, that means increased equity beta, justifies the increase in the value of equity. Beta we can say on account of leverage. Yes sir, it justifies the increase because higher capital, higher debt in the company increases the risk of the equity shareholder. It's very simple. The answer given by the institute will be confusing to you. I will just write down the other format of this answer, like other way we can answer this. I will just write it here. Yes, it justifies the increase in beta value as higher debt in the company increases the risk, which is also called as beta of equity. That's it. The more you bring capital, debt capital into the company, the less are the chances that you will get anything on the liquidation. If you remember, I told you about this while explaining the geared and ungeared beta, that if we have debt in the company of 2 crore and at the time of liquidation, we have only 2 crore, this entire 2 crore will be given to the debt holders because they are also of 2 crore and equity shareholders will not get anything. So higher amount of debt in the company, lesser will be the chances, lower will be the chances that equity shareholder will get anything at the time of liquidation. Question number 61 is your homework. It is exactly same. We have to calculate the equity beta twice. Let's come to the next and the new question. Quite interesting one. Have a look. Following information is available of Messrs TS Limited. PBIT 5 less interest, that is in crores. You can write down, it's in crores. So profit before interest and tax is 5 crore, less interest on the debt is 1 crore, PBT less tax, PAT. Number of shares outstanding is 40 lakhs, earning per share is 7.5. Okay, divided by market price divided by earning per share will be the PE ratio, that is 10. Now TS Limited has an undistributed reserves of 8 crore. Now try to understand what is the share capital. Share capital is 40 into 10, that is 400 lakhs, which is also called as 4 crores. So share capital is 4 crore and reserves and surplus is 8 crore right now. So the total capital is 12 crore equity, and equity shareholders fund is 12 crore. Apart from that, if you will understand, 1 crore is the interest calculated at 10% rate. What is the total amount of debt? The debt will be 10 crore. On 10 crore, if you apply 10%, then the interest comes to 1 crore. So debt is 10 crore. Total capital employed by the company is 22 crore. Do you agree? 22 crore. Now, company requires 3 crore for the purpose of expansion, which is expected to earn the same rate of return on capital employed at present. What is the capital employed at present? 22 crore. That's why I calculated this. And what is the return on the capital employed? Try to understand. The capital employed is profit before interest and tax. This PBIT belongs to the debt and equity. So if you are taking 22 crore capital employed, take the PBIT figure. Or if you take just the PBT, you can take then 12 crore rupees. If the profit is of equity, the capital should also be of equity only. If the profit is of equity and debt, the capital should also be taken for equity and debt. So what is the total capital, we can say the return on capital employed? 5 by 22. 5 divided by 22 comes to 22.73%. This is the return on capital employed. Now the question says that right now we have 22 crore in the debt. I will just show you. Equity is 12 crore, debt is 10 crore. So right now we have 22 crore of the capital plus 3 crore is required. So the total capital after that will be 25 crore rupees. Now, right now on 22 crore we are earning 22.73%, and the question says that the same percentage of earning will be there on the 3 crore as well, 22.73%. That is what the question is saying. So if the percentage of earning on both is same, what will be the new PBIT? New PBIT after raising 3 crore will be 22.73% of 25 crore. The new PBIT. 5.6825. Are you okay with this? Now, however, if the debt to capital ratio is higher than 35%, then PE ratio is expected to decline to 8. Try to understand. Right now, debt is 10 crore. Debt to capital, debt to capital employed ratio. It's not debt to equity, it's debt to capital employed. So 10 divided by capital employed, 22 comes to 45%. And if you take 10 divided by 25, it comes to 40%. That means the current debt itself is more than 35% ratio. Question says that if the debt ratio of the company goes beyond 35%, then the PE ratio will decline to 8. So what should be the new PE ratio that we have to take? 8. Okay. And the rise in the cost of additional debt will be 14%. So this 3 crore will cost us at 14%. This 10 crore is costing us only 10%, right? You can clearly see it here. But this 3 crore will cost us 14%. Remember that. So what will be the new interest? Very simple, sir. 10 crore into 10%. The new interest will be 10 crore into 10% plus 14% into 3 crore. Calculate 10% on this and 14% on this. It will come to 1 plus 0.42. That's interest 1.42. That is only if all the 3 crore rupees that you need is raised through debt. If you raise the additional 3 crores through debt, you will have to bear 14% cost on that. And at that time, the interest cost will be 1.42. 14%, 3 into 14%, yeah, 0.42. Cool. And then the PBT will be PBT, tax, PAT, number of share, and then the P ratio of 8. Okay. Given this data, which of the following options the company would prefer and why? If the required amount is raised through debt, if you raise the debt of 3 crore. And second option, if the required amount is raised through equity and the new shares will be issued at a price of 25. 3 crore divided by 25 comes to 0.12 crore shares. So there are two options. Either you go through equity or you go through debt. Very simple. Question number 62. Now the story is almost over. Option 1, option 2. I will just take the answer from the institute because it's easy. Easy means it's the same that we need. See, this is the revised profit before interest and tax. Existing capital employed is 22 crore, additional required is 3, and on both 22 and 3, we are going to earn the same return on capital employed, 22.73%. So the new PBIT will be this much. Okay. You can see the new debt. If you raise the existing debt is 10, if you raise the additional amount with option 1 in under debt itself, the total debt will be 13. So if you will calculate 13 on 25 crore, it goes to 52%, which is greater than 35%. Since it is greater than 35% mentioned in the question, P ratio will be 8 times. Existing debt itself is also more than 35%. So in option 1 and option 2, just try to understand equity and debt portion. How much is the equity and how much is the debt? I will just write down. In this debt 1, in this equity will be 12 crore, debt will be 15, 12, 10 plus 3. That's 13 crore, na? 13 crore. And the total capital will be 25. In option 2, it will be 12 crore. Equity will itself be 15 crore and 10 crore. But if you will realize the debt ratio in both 13 to 25 and 10 to 25 comes to 52% and 40%. In both the cases, the debt ratio is higher than 35%. Therefore, P ratio in both will be 8 and 8. So forget about what the P ratio is given in the question. Now start with PBIT. In both the cases, you are going to earn the same rate of return in profit before interest and tax. That's 5.6825. 5.6825 less interest. Here the interest will be 1.42. Do you understand how this is calculated? On the previous debt of 10 crore, we will be paying only 10%. On the new debt of 3 crore, we will be paying 14%. And in the other case, the debt is only 10 crore because the rest of the amount is issued by the equity. You can see in option 2, equity has increased by 3 crore. So it will be only 1 crore. So what is left? PBT, tax, PAT, number of share. Now tell me how much is the number of share in equity. In the option 1, there is no new equity share. So number of share will be same, that is 0.40 crore. I think 40 lakh means 0.40 crore. And in the option 2, you have raised additional equity at the rate of 25 rupees. That's 0.12 crore. The total equity capital will be 0.4. The number of share, the total number of share will be 0.4 plus 0.12. The new shares issued at 25 rupees. This will give you EPS. Take the P ratio of 8 and 8. Then calculate the market price in both the cases. Let's have a look on the answer now. See. 5.685 in both the cases. 1.42 is the interest here because you have raised it through debt. Then PBT, tax of 25%, profit after tax, number of share 40 lakhs and 52 lakhs. You can write it in crores as 0.40 and 0.52. This will be your EPS multiplied with the P ratio of 8 and 8. Forget about the P ratio what is given in the question, because in both the cases, the debt ratio is 52% and 48%, which is more than 35%. So the P ratio will be 8. New share price is this. Which option is preferable? The first option is preferable because in that case, the market price of the equity is higher. Market price. Since the market price of share is expected to be more in case of additional financing done through debt, we will prefer that option. That's it. These type of questions were there in the capital structure decision. This is the question of a capital structure decision where you change the capital structure, debt and equity. And this was already covered. Some of the questions like this was already covered in CA Inter. I don't know why they are asking again in the CA final. That's why we have taken this question. If you will see, this was the question asked in November 2019 new syllabus CA final, 8 marks. Similar was the questions. You can find similar questions in the CA Inter capital structure decision as well. Cool, sir. We are going to now end the chapter with question number 63. Let's have a look on the last question. The balance sheet of Messrs Sundry Limited as on 31st March 2020 is as follows. Share capital, reserves and surplus total 500 lakhs, long-term loan 400, short-term loan 300, payables and provision 200. This is the total. Okay. Fixed assets on the other side, inventory, receivables and cash on this side. Sales for the year was 600 lakhs. It was. The sales are expected to grow by 20% during the year. That means 120 more. So the total will go to 720. Sales will be 720 this year. The profit margin and the dividend payout ratio are expected to be 4% and 50%. 4% will be the profit margin. That's 28.8. This is the profit, and the payout ratio is applied on the profit itself, which is 50%. That means the dividend payout will be 14.40. So this is the new sales, profit and dividend. Okay, sir. The company further desires that during the current year sales, current year sales to short-term loan and payables and provision should be in the ratio of 4:3. Current year means 600 lakhs only. So 600 lakhs, I will show you, sales divided by short-term loan, that is this figure, and payables and provision, that is this figures, should be in the ratio of 4:3. Okay, so let's write down the sales figure. 600 divided by short-term loan and payables and provision is equal to 4/3. So what is the short-term loan and payables and provision? 600 into 3/4 comes to 450 lakhs. Okay, and right now we are having 500 lakhs. Existing is itself 500 lakhs. Cool. Ratio of fixed assets to long-term loan should be 1.5. Fixed assets to long-term loan. Now you need to understand one thing. If you remember the corporate valuation questions, sales is increasing by 20%. That means the entire balance sheet will get affected. This is the part of the balance sheet. This is where the share capital, reserves and surplus and long-term loans and the capital related parties are there. This is the capital. This is current liability. This is current assets. This is fixed assets. Now, mostly what will happen if the sales are increasing by 20% and nothing else is given in the question, this fixed assets will also increase by 20% and the working capital will also increase by 20%. It will be in the same ratio. Now, this is not a rule, but if nothing is given, you are going to impact the balance sheet with the same percentage. So you need to understand the new fixed assets and the new working capital. This is the funds required. If you want to add the fixed assets in the company, you will have to make the arrangement for capex, capital expenditure, and change in working capital. You remember that? Profit after tax, and then we deduct the capital expenditure and change in working capital. So what is exactly the funds required to add more fixed assets and more working capital? Okay, so current fixed asset is 600. Try to understand. 600, you can see. And what is the total of the working capital? Inventory, receivables, cash minus payables and provision. This will not come under the non-cash working capital. This will not come under the working capital itself, liabilities. This will only be the part. We will keep this separate. Payables and provision is 200. So understand, 500, 240 plus 60 minus 200. The working capital is also coming to 600. I will just write down 500 plus 240 plus 60. That's 800 minus 200. So what is the extra capital expenditure required? 120. Extra working capital required 120. The total fund requirement is 240. 240 is the total fund requirement. That's what the question is. See, the question is amount of external fund requirement. But try to understand, this is 240 is not the external fund requirement. It is the total requirement. Now what is going to happen? We are going to fund this requirement first with the amount or the money that we have already in our reserves. Can you see this? Sales net profit margin is 4%. So the total profit after tax is 28.8, out of which 50% was paid to the shareholders. This is dividend, and balance 14.4 will be called as reserves and surplus. This is the internal fund that we already have, can be used for the total requirement. Existing reserves and surplus, we are going to use this time 14.40. 240 minus 14.40, this is 225.60. Now try to understand. We need the capex, we need the working capital, and the total of it comes to 240 lakhs. Out of which the existing this year's reserves and surplus is 14.40. So we try to fund this requirement by internal profits that we have made this year, which is 14.40 lakh. Now rest of the amount, that is 225.60, will be called as external fund requirement. Now we have to bring this amount from outside the company. We can raise the debt, we can raise equity also, anything, but it will come now from outside the company. That is 225.60. Have you understood this? Now let's have a look on the answer. See, expected sales is 720. Do you agree? 4% of that is profit margin, 28.80. Out of this profit margin, you have paid 50% dividend payout ratio, and the balance 50% is plugged back. That means you are using this money for the internal fund requirement. Now, the total fund requirement is calculated like this. It will be little difficult for you to understand. They have taken the total assets of 1400 minus 200. Try to understand. The total of the asset side is 1400 minus payables and provision of 200. It means the fixed assets and the working capital. The net of the fixed assets and working capital is 1400 minus 200, that is 1200 into 20%. This is 1200, which includes 600 of the fixed assets and 600 of the working capital. That's what we have written here. The fixed assets and the working capital, 600 and 600. Okay. So 1200 into 20% is the total required. 240 lakhs is the total required, and out of this total fund requirement, we are using the internal funds that we have, internal profits that we have made this year, which is 14.40. Now the balance will be met from the external sources. That's why we will call it as external fund requirement. Do you understand the concept of external fund requirement? The fund that will be raised from outside the company. Okay. This is one thing. Now this 225.60, question is asking you 225.60, how much of that is raised through short-term loan, long-term loan and equity fund? So the bifurcation of 225.60 has to be given in this type, and that's why we didn't take short-term loan in the working capital, because this is what we raise from outside the company, from the bank. This is also from the bank, and balance will be the equity capital from the public. So if you try to understand the entire situation, if we cover up this much of the part of the balance sheet, we need 240 lakhs here. Okay, 240 lakhs here. We will match the balance sheet, out of which 14.40 lakhs is being contributed by the internal funds, which is reserves. Okay, this year's profit. Now you need to tell us 240 minus 14.40 comes to 225.60. How much of that 225.60 is the long-term loan, short-term loan and share capital? Okay. Now, coming over to this part, ratio of fixed assets to long-term loan. How much is the total fixed assets now? 600 plus 20%. We need 720. See, the new fixed assets is 600 plus 20%, that's 720. And the ratio of fixed assets to long-term loan is 1.5. That means 720 divided by 1.5 should be equal to long-term loan. So the long-term loan that can be maximum stay in the company is 480. After the increase in fixed assets, we can increase the long-term loan as well, because we can put that extra fixed assets on mortgage and raise the loan. That's the normal procedure in the market. So the long-term loan total can be 480. Right now the long-term loan is 400 only. See, existing loan is 400 only. That means 80 lakhs of the extra loan, long-term loan can be raised. So we now will contribute 80 lakhs from the long-term loan. Okay, that's cool. Ratio of the fixed assets to long-term loan should be 1.5. Yeah, this ratio, do you understand this ratio? Sales, current year sales to short-term loan and payable and provision, it was coming to 450, but we already have 500 existing. That means we cannot raise additional short-term fund. It is already higher than required. The required balance in the short-term and payable and provision in total should be 450. And existing balance itself is 500. So what extra will you raise? Nothing. So the short-term loan will be 0. And the balance now will be contributed by share capital. This will be the balancing figure. So 225.60 minus 80 of the long-term loan minus 0 of the short-term loan equal to share capital. That's 145.60. Now you can do the total of all the four figures. Share capital contribution will be 145.6, reserves will be 14.40, long-term loan will be 80, we cannot raise further short-term loan, and the total will be 240. This 240 of the extra funds that required will be used to fund the fixed assets and working capital of 240. So 240 on the liability side, 240 on the asset side will match the balance sheet. The balance sheet total will match according to this. Now try to understand. These are the three requirements. See, short-term loans and payables and provision. New amount of short-term loans and payable and provision will be 450, but existing amount is itself 500. That means amount to be raised from the short-term fund is nil. We cannot raise anything. So that's 0. Next, new fixed assets is 720, of which we can have 480 as the long-term loan. 720 divided by 1.5. What is the ratio? Fixed assets to long-term loan should be equal to 1.5. So fixed assets divided by 1.5 can be equal to long-term loan, which comes to 480. Existing long-term loan is 400. So we have a scope of raising 80 lakhs of extra long-term loan. That's it. The balance amount will be raised from the equity. Total is this much. 0 from the short term, long term 80, and the balance amount from the equity. So this is how you have funded the total requirement. I will just write it down. Total fund requirement was 240 lakh, and this 240 lakhs comes from the capex and increase in working capital. Capex was 600 into 20%, that's 120, and change in working capital 600 into 20%, that's 120. So this is how we have calculated 240. Out of the 240, current year's reserves and surplus was 14.40. Now the balance amount will be called as external fund requirement, because now we have to go outside the company to fund this, which comes to 225.60, and this has funded through 3 different means: short term, long term, and equity. Short term loan, long term loan, and equity. Short term loan 0, long term 80, and equity 145.60. This is how we have funded. I hope you have understood the entire question now. So with this, we end this chapter of mergers, acquisition, and corporate restructuring. Practically speaking, we have finished the fast track batch here. The last chapter, that is startup finance, there are 2 questions. In the next lecture, I am going to finish this easily in like half an hour maximum, and then I will suggest you a couple of things which you need to make sure that you go through the revision very well, and then we are going to say bye bye to each other. It's a very long journey that we have covered. If you are watching this lecture, that means we have covered a long journey, and it is going to be a wonderful thing. So wait for the next lecture. Just complete it. Just after finishing this lecture now, take out half an hour. That's it. Maximum half an hour I will be taking, and finish the next lecture, because there will be some important tips in the last lecture. See you, sir.